Hi friends, this is Kumar. In this video presentation, I am going to introduce a new concept called adjusted NPV methodology. Few people thought that the NPV technique discussed at IPCC level and the adjusted NPV technique both are similar. Of course, NPV methodology and adjusted NPV methodology both are project evaluation techniques. The purpose of these two evaluate the long-term investment, whether they are worthwhile or not. So we are deciding the profitability of the project using these techniques. However, the methodology of computation is quite different. This adjusted NPV methodology was introduced to eliminate some of the limitations of NPV methodology. So before highlighting the importance of adjusted NPV methodology, first we have to look at what is NPV, how it is computed, what is the purpose of using NPV methodology. See, for evaluating various long-term projects, we have been using several DCF techniques, discounted cash flow techniques. Like we already aware that what is DCF technique? DCF technique considers the time value of money. It differentiates today's rupee with tomorrow's rupee. So it converts all the future benefits into today's value. Then it makes a rational judgment. In this discounted cash flow techniques, we have seen several concepts like NPV, profitability index, IRR, discounted payback period. So in those concepts, the most superior methodology for evaluation of various long-term techniques is the NPV. NPV means, what do you mean by NPV? NPV means net present value. It is the profit that we are going to receive if the investment under consideration accepted as on today. So NPV indicates the profitability of the project as on today. So it simply tells you how much profit you are going to get or how much loss you are going to suffer if the investment under consideration is accepted. So to highlight this concept, to elaborate this concept, just look at this a small example. See, a company wants to start a new project which would cost 400 lakhs. They want to start a project. So you are already aware that project means purchase of a machinery is a project. Construction of a factory building is a project. Construction of a office building is a project. Introduction of a new product is a product. Similarly, if you want to construct a commercial complex, that would be a project. So project means a long-term investment. They want to go for a new project that would cost 400 lakhs. So they are expecting that this project would run for 4 years and this 400 lakhs has to be financed with two sources. 50% from the bonus contribution, that means 50% will be contributed by the company's bonus and the 50% will be taken from debt. So company wants to fund this project by debt and equity in the ratio of 50:50. So cost of debt means your borrowing cost. You are getting 400 lakhs into 50% means 200 lakhs. These 200 lakhs were borrowed at 10% rate of interest. That is what we call as borrowing cost or cost of debt. So the company's applicable tax rate is 50%. The company is subject to tax at the rate of 50% on the taxable income. So cost of equity 15%. The company's equity shareholders or owners are expecting 15% return on this investment. Now we need 400 lakhs. So this 400 lakhs will appear in the asset side of the balance sheet as a project or as a long-term investment. So at the liability side, you have to differentiate how this project has to be funded. 50% comes from debt and 50% comes from equity. So the cost of funds being the 200 lakhs which are borrowed from equity shareholders has to be compensated by 15%. 200 lakhs borrowed from the lenders has to be compensated by 10%. We call it as cost of equity and cost of debt. So these two concepts are already aware in the chapter called cost of capital at IPCC level. Now, if I made 200 lakhs, 400 lakhs investment in this project, company expects the following cash flows after tax over next 4 years. So in the first year, they are anticipating that they are going to get 120 lakhs cash profit. Second year, 144 lakhs, 172.8 lakhs in third year, and fourth year, 207.4 lakhs. These are all future economic benefits. See, you are already aware that suppose I bought a building and which is rented, which is given for a lease. Suppose every year from that building I will get some rent. The receipt of rent is called as future economic benefit. I and the tenant had a 10 years agreement, long term agreement. So from today until the completion of 10th year, every year the tenant or lessee pays rent on regular intervals, that is at the end of the year. So for lessee point of view or tenant point of view, that is cost. From my perspective or lessor or owner perspective, that is cash inflow, benefit. So any long-term investment requires substantial investment as on today, but we are anticipating some economic benefit from that asset in the near future. That's why if I made 400 lakhs investment as on today, over a period of 4 years, that project will give me 120, 144, 172.8 and 207.4 lakhs cash profit after payment of all expenses and taxes. So this is the net benefit I am going to get. Assuming no salvage value, after 4 years I won't get any value by disposing these assets which are taken for this project. So we have 400 lakhs worth of project that may consist of plant and machinery, factory buildings, etc. If I dispose these assets at the end of 4th year, I would get zero value. That's why they are saying that assuming salvage value is zero. You are required to compute NPV of the project. See, from my perspective, I need to invest 400 lakhs. When? As on today. So if I invest 400 lakhs in this project, my capital 400 lakhs apparently blocked in that project. Then, if I ready to do so, I would get 120, 144, 172.8 and 207.4 lakhs over a period of 4 years. See, from this project, I should recover two aspects. The money I am going to invest in this project, that is 400 lakhs. Apart from that, these 400 lakhs were borrowed at a fixed rate. At the time of borrowing, I have commitment. I promised that I will give you 15% return, I will give you 10% return to different parties. I call the shareholders and says that yes, I will give you 15% what you are expecting. I call the lenders, I am saying that yes, I am going to take a loan from you. On that loan, I will repay interest at the rate of say 10%. I made promise to both the parties. So principal recovery is not only the factor, I should also recover my minimum return expected by the investors. So principal plus minimum rate of return whenever recover from the project, then only I will make some profit from this project. So for any investor, whether you are an individual or a partnership firm or a company, all you need to do is to ensure what is your exact investment, then what is the commitment to that investment. The commitment to that investment, we call it as WACC, weighted average cost of capital. So, sir, what is the NPV of the project? NPV is nothing but profitability. Whether you are making profit, whether you are suffering loss by investing 400 lakhs in this project, that we have to decide. The outcome of the project in layman terms is called as net present value. In financial terms, we call it as NPV. For a layman, it is the expected profit or loss on the project or investment. See, to know the profitability of the project, to evaluate the profitability of the project, we need few steps. First of all, we have to estimate the investment amount. How much money that is going to be invested. See this? So cost of the project here 400 lakhs. Sometimes we require working capital. Working capital means capital required to operate the business. Suppose you want to start a restaurant. Then you have to purchase a building or you have to take a building on rental basis. Then you have to do necessary modifications so that you have some investment. Apart from that, every day you have to prepare several food items. You have to make payment to suppliers. You have to make payment to workers. You have to make payment of rent. You have to make payment of salaries, like that. These are all operating expenses. To meet those expenses, we need some cash. That is what we call as working capital. So 400 lakhs, they don't have any information about working capital. They're simply saying that the cost of project, expected cost of project would be 400 lakhs. That's why I have taken 400 lakhs as an investment. In case if there is any additional working capital requirement, that should be added. Apart from that, any installation costs have to be added. Any carriage inwards have to be added. Any subsidy, if you get any subsidy from government of India or any other entity by purchasing this machine, that subsidy has to be deducted. After making all those adjustments, this final investment will be arrived. See, we have 400 lakhs investment in this project. Then, listen carefully. These 400 lakhs borrowed in the ratio of 50-50, 200 lakhs from external source, 200 lakhs from bonus. So the money borrowed from external sources is, we call it as debt in financial terms. 200 lakhs of debt and 200 lakhs of equity. Now tell me, this 200 lakhs was borrowed at 15%. This 200 lakhs was borrowed at 10% only, but this interest amount every year charged to profit and loss account. On account of that, my taxable income will come down. As the taxable income has come down, my tax liability will also come down. As a result of that, I would get some benefit on tax, or I would get some benefit on account of interest amount charged to profit and loss account. That is, we call it as tax benefit on interest. For example, My gross profit was 100, my interest payment was 10. By 100 to 10, so net profit is the 90. 90 into 50%, 90 is the taxable income, on that I have to pay 50% tax. 90 into 50% means 45 rupees is my tax liability, that is paid in cash outflow. Suppose if there is no interest, I have a gross profit of 100. If there are no other expenses, that case 100 into 50%, my tax liability would have been 50. So instead of paying 50 rupees, right now I am paying only 45. So my tax liability has come down by say rupees 5. That is called as tax benefit on interest. That's why my cost was, my commitment was 10%, on that 50% tax benefit will be enjoyed by me. So the balance cost after tax benefit on interest is just 5%. So from my perspective, my borrowing cost, actual borrowing cost is 10%. My explicit cost is the 10%, but the actual cost was only 5%. Because I got 5% tax benefit on the interest payment. This is net. So 200 lakhs into 5% means I need 10 lakhs. 200 lakhs into 15% means 30 lakhs. Put together, I need minimum 40 lakhs profit from this project. If I want to justify the finances, every year I should get 40 lakhs, minimum 40 lakhs from this project. So if you take this 40 lakhs and 400 lakhs, your cost would be, average cost would be 10%. This is in financial terms, call it as overall cost of capital. Overall cost of capital. So I need minimum 10% return from this project. So third step, what we have done, present value of operating cash flows. First year, second year, third year, fourth year. In next 4 years, I am going to get this amount, 120, 144, 172.8 lakhs and 207.4 lakhs. See, every year, whatever amount I am going to get, that consists of two components. My principal recovery as well as some return. My principal recovery as well as some return. See, 120 lakhs, 144 lakhs, 172.8, 207.4. This 120 lakhs is useful to two things: to recover my investment, at the same time to recover my interest. See, how much interest I must get this from project. So this is minimum 10%. That's why in 120 lakhs, I have deducted 1 year interest at the rate 10%. This 144 lakhs, I have deducted 2 years interest at the rate 10%. From 172.8, I have deducted 10% interest for 3 years. Similarly, from this 207.4, I have deducted interest at the rate of 10% for the 4 years. See, this is future value consisting of P plus I. I cancelled out 10% interest every year. That means if you cancel the P plus I, if you cancel the I, then you must have only P when you add these four values. P plus I, P plus I, P plus I, P plus I. Na? This is P plus I. This is P plus I. So you are deducting 10% interest. So if it is 10% interest thereon, you have only principal amount every year. So after 4 years, you have recovered, every year you have recovered 10% interest thereon. As of now, if this project gives you 10% rate of interest, That case, you would get your principal back. So if you add all these, this amount must be equal to 400 lakhs. That is what you have invested as on today. What you have invested as on today. See, the total was 499.45 lakhs. It indicates that every year this project gives you some return. This project gives you some return which is more than 10%. But I need only 10% thereof. In fact, I designed this model by considering 20% return from the project. And that means in every year cash flow, 20% return was added. In the first year, you have 20% return, but you are discounting only 10%. You need only 10%. In second year, P plus 20% is there, but you are deducting only 10%. That means P plus 20, you are deducting the minimum return expected by you. So you are left with P plus 10%. Your principal will be recovered. At the end of the day, you are left with your principal plus 10% interest. So this 499.45 lakhs consisting of two values. Your principal along with some return from the project. I got 20%, I am paying 10%, I left with 10%. That 10% plus principal is equal to 499.45 lakhs. Out of this 499.45 lakhs, I must repay the principal amount. If you cancel this, you are left with 10%. That 10% we call it as NPV, net present value. See this? $499.45 lakhs, we call it as, this is the amount as on today, available as on today to repay our principal. But my principal was only 400. Out of 499.45 lakhs, if I paid 400 lakhs, I left with 99.45 lakhs. That is the profit from the project. So, if this project is accepted as on today, I would get a profit of 99.45 lakhs. If you ask me, why did you get 99.45 lakhs profit from this project? The concept is so simple. See this? From this investment, you are getting 20% return. To finance this investment, you are getting funds from equity and debt at a cost of 10%. Out of 20% return, you are paying 10% every year. So you left with, for doing this project, by accepting this project, you left with a profit of 10%. That 10% we call it as NPV. So if you convert this 10% in rupees value, that rupee value we are defined as NPV. So if you ask me, when do you have positive NPV, when do you have negative NPV? The answer is so simple. When you are getting money at 10%, you must make investment at the rate more than 10%. When you are investing at more than 10%, you always be in a profit. If you fail to invest this amount at minimum rate of it of 10%, then you would suffer some loss. Suppose I got money at the rate 10%, but makes investment at 8%. You have to suffer with a loss of 2%. Who has to suffer that loss? The shareholders has to suffer the loss. Therefore, this investment 400 lakhs will get some return every year. This return is called as IRR, internal rate of return. Internal rate of return is the actual return earned by the project. WACC is the minimum return expected by the project, expected from the project. See, I am the businessman. This is my balance sheet. If I invest money, I disclose at the balance sheet side. If I borrow money, disclosing at liability side. What is the reward by running this project? What is the reward by operating this project? If you question like that, then I have to ensure, yes, I am getting money at 10%. Oh, yes, I got 20%. I am expecting a return of 20% this project. So out of 20, if I pays 10%, I left with the 10% return. That 10% is the NPV. This is how all the long-term projects are evaluated at the basic level. But NPV evaluation has some limitations. See this? You are borrowing money at 10%, right? Out of 10%, you are getting tax benefit of 5%, okay? 10 minus 5, you are disclosing your net borrowing cost. You are saying that you have to pay net cost of 5% to the lenders. The project has to provide minimum 5% return as far as the company is concerned. So from company state, we have a obligation of 5%. From company's equity, we have an obligation of 15%. Yes, absolutely correct. Tell me, in this question, I fixed the IRR at 20%. That's why you have positive NPV, 99.45 lakhs, etc. See, if I fix IRR at 8%, definitely this project NPV turn out to be negative. This is not a profit making project. At the end of the day, it turned out to be loss making project. Now tell me, if it is a loss making project, who has to suffer the loss? The shareholders has to suffer the loss. But you are saying that, yeah, I am getting 200 lakhs from the lenders. I need only 5%. I need only 5% to compensate them. Yes, exactly correct. You are already aware the concept called leverage. When you are borrowing money, inherently you have financial risk. So if you make better investment, if you make investment in profitable investments or profitable projects, you don't worry about the outcome. Then you have selected a project, you thought that it is a profitable one, but at the end of the day it ends with loss. That case, who has to suffer the loss? The company has to suffer the loss, the shareholders has to suffer the loss. But you are not taking the risk associated with the financing. You are taking, yes, we have to pay 5%, yes, exactly correct. Then what is the reward to the shareholders for undertaking the risk therein, financial risk therein? If I am not getting any return from this project, still have to pay 5% to the lenders. The risk of financing is not considered in the normal evaluation. While evaluating a project, you are taking WCC as a discounting factor, this 10%, that is absolutely correct. When you have to take this 10% as a discounting factor, when you don't have any risk in this project. But there is no guarantee that this is a risk-free project. Sometimes a project may be risky project. We are predicting the future. We are estimating the cash flows upon the information which is available as on today. The conditions might be changed in future. If conditions are changed, the project outcome would be changed. Consequently, a profit-making project turn out to be a loss-making project. Therefore, it is not proper, it is not prudent to to consider 5% return to equity lenders. Yes, you have to pay 5%, but as far as the shareholders are concerned, you have to pay 5% to the lenders, means you are taking some risk. So for taking those additional risks, they need some additional return. That risk aspect, financing risk aspect, was not covered in the WCC evaluation. You should not use 10% as a discounting rate. You must use more than 10% as a discounting rate because of inherent financial risk attached to this project. That is point number one. This is not taken care by WCC. Point number two, you are saying that your borrowing cost was 10%. In some cases, companies gets money at a very cheaper rate when compared to its normal borrowing cost. For example, I want to start a project in Sri Lanka. I want to start a project in Pakistan. They are undeveloped countries compared to India. India has a better position than these two countries. When you start projects in those developing countries, the government may encourage you, the governments may provides you some reliefs as far as these projects are concerned. That case, the undertaking which takes investment or which makes investment in those countries will get concessional loans from the government, or they get subsidies from the government. So those concessional rates, the concessional rate of interest on those loans may not be equal to 10%. You are getting, say, money at 7%. That case, your actual borrowing cost was only 7%. But here, you are evaluating this project by taking cost of debt at 10% and cost of equity at 15%. In fact, your actual borrowing cost was 7%. So we are assuming that we are borrowing money at the rate which is prevailing in the India. But that case, the actual borrowing cost is quite different. When the actual borrowing cost is differs, you may have different WCC than 10%. But while evaluating NPV, we presuming that there is no change in WCC. That means our cost of debt and cost of equity won't change. Our financing mix won't change. The rate of return expected by the shareholders and the rate of return expected by the lenders will remain constant. But practically speaking, the rate of interest expected by lenders always varies from project to project. With respect to high risk projects, they require high return. With respect to low risk projects, they require less return. So there is no fixed rate of interest, there is no fixed rate of return expected by the shareholders. That's why WCC can be taken as a discounting rate for evaluation of any project only when you are undertaking the same project and at the same time you don't have any change in your borrowing cost. So this is second one. Third one, see, out of 10%, 50% tax benefit is considered. Your net borrowing cost is taken at 5%. Tell me, do you have fixed tax rates? In this year, you may have 50% tax rate. In the next year, that may be either increase or decrease. Say, it may increase it to 55%, or it may fall to 45%. That means the tax rates are always fluctuating according to the government policies. But in that case, the effective cost of debt varies from year to year. So this year, your effective borrowing cost is 5%. In next year, that may be changed. Whenever effective cost of borrowing varies, it will affect your WCC. Therefore, discounting rate what you have taken for evaluation of this project is not correct. In order to overcome these limitations, they have introduced a concept called adjusted NPV method. So, adjusted NPV method is a project evaluation method which is similar to NPV. The purpose of this is to overcome the deficiencies which are incorporated in the NPV methodology.